Yeah. Thank you, Jitendra. It's a privilege to give an introduction of CA Abhishek Murali. His degree goes into two lines: BCom, MCom, MBA, FCA, ACMA, LLB, CGMA, CIMA, London, CISA, USA, DISA, ICAI, ADIT, UK, Delight. So you can see about how much knowledge he has on these subjects. And to just briefly introduce him, he's a practicing chartered accountant at Chennai and presently partner at Victor Grace and Company Chartered Accountants. After doing his articleship with PwC, he has worked in KPMG in transaction advisory and merger and acquisitions. He has secured first rank in the SEMA statutory examination and All India 17th rank in final examination. He was the elected youngest regional council member for two terms in SIRC from 2016 to 2022 by securing highest number of votes in Tamil Nadu and was elected the secretary of SIRC for the year 2021 during the term which the region won the best region award for ICI for first time in more than 10 years. He is presently the president of All India Taxpayer Association and is a founding board member of ARK Foundation, which plays a key role in providing underprivileged family access to expensive medication at affordable prices, and also a member of committee for implementation and survey of faceless assessment and faceless appeal proceeding constituted by the Ministry of Finance, Government of India. He's an expert in direct taxation, international taxation, litigation, appeals, valuation, due diligence, merger acquisition, and professionally advises various leading industries, HNIs, and professionals. He's very passionate about the startups and went on to establish a vertical to help mentor startups. Over the years, he has held various positions in the various committees of Institute, New Delhi, and SIRC, and other educational and social organizations also. We'll share the detailed present profile also on the WhatsApp, but it's a very detailed one. Just to conclude that he has authored very background material for investor awareness reference published by the ICAI, and he regular contributes articles of professional interest in online tax magazine, Tax Sutra, and other online portals, and he has addressed more than 2,200 conferences, seminars, and workshops organized by corporate forum, professional bodies, universities, and income tax and central excise department on various topics like tax appeal, capital gains, tax planning, corporate law, valuation, mergers, due diligence, soft skill, career rotation, and he was facilitated with the Gold Star Award by Padma Shri Dr. Swami Anandurai, Director ISRO, for addressing more than 500 seminars during the COVID period alone. Anida regularly appears on national and regional TVs channel. He's an avid golf, badminton, squash, football, and tennis player, TT player, and keen follower of the game of football. And he regular blogs and enjoys reading. So, with this profile, I welcome you, sir, to the gathering and request you to take over. Thank you.
Thank you. Thank you so much. Very, very warm good evening to one and all present here. Firstly, the convener, CA Jitendra Kotariji, Deputy Convener, CA Uttar Sharma, and coordinator of the program, and who very kindly gave me such a lovely introduction, Sri Aditya Maheshwari sir. Thank you very much for inviting me. Of course, I should also thank my good friend, Amish Sangoy, who has always motivated me. And I think this is maybe the third or fourth time I'm speaking in Andheri Study Circle.
Yes, sir. Yes, sir.
So it's I always feel immense love and gratitude from the members of your study circle, and I've always got a very, very interactive and lovely session. I hope that this session will also evoke such a similar response. And to just to brief about the session, at any point of time, I request you to please keep putting your opinions or your views in the chat box. If you have any questions also, please put it in the chat box. I'm keeping the chat box open at all points of time. So when Suhas sir says such a big mic, I am reading that also. So I request you all to please do. I like it. It's much more interactive that way. Since we are not physical, we'll try to keep it as interactive as possible. So as long as my volume is good, Suhas sir, I am happy. I don't care about the size. Size doesn't matter. So I hope we can proceed with the topic. So taxation of capital gains. I think it's an excellent topic of choice by the coordinators because it's an evergreen topic. Unlike your tax audit, unlike your income tax filing season, unlike your bank audit, whatever it is, these are all time driven. It's like seasonal, like winter season, summer season, like that. We have our tax audit, return filing, and bank audit. But capital gains is evergreen. At any point of time, you will have this scenario of capital gains coming, some doubt, some client approaching you. You get on a bus, you get on a train. By mistake, you tell the person you're sitting next to, sir, I am a chartered accountant. Immediately he says, sir, I am selling one land, sir. I have one old house property, sir. I inherited from my father. I want to sell it. What is the tax? So it's an evergreen topic. So therefore, it's also very interesting. It is one of the few chapters in the Income Tax Act where it has multiple tax rates, 15%, 10%, 20% with indexation, without indexation, up to 1 lakh rupees exemption if you're telling long-term capital gains on sale of shares. And then after that, taxable at 10%. Short-term capital gains on anything other than shares means it is taxable at slab rate. If it is shares, it is 15%. So many different rates. Then it also has cost of acquisition benefit. No other head of income has this, where you not only get the benefit of your cost of acquisition, but they're also saying, please adjust it for inflation. Take whatever you can to save the tax. So whatever resulting is your capital gains. And after that, it does not end there. Then they say you have exemptions, section 54, section 54EC, section 54F, multiple sections are there, which further encourages people to save tax. So essentially, capital gains is one of the few provisions in the Income Tax Act where you're empowered with so many tools to simply save the tax. So therefore, it is essential for us. And it's one of the few sections where every single budget, there's a change. Every single week, there are multiple case laws across the country. And it's a matter of immense, importance because of the size of the transaction. A person selling a land or selling, a house property or sometimes even shares, the transactions run into at least minimum lakhs, if not crores. So therefore, the importance of this chapter is extremely important to us as professionals. So we are going to talk about in today's session some of the key definitions, latest developments, and practical case laws which we can use to save tax for our clients, because that is the most important takeaway that we can have, is how we can save the tax in the capital gains. So before we get there, among the latest developments, if I have to start that, I have to start at point number A or point number 1, which is what is a capital asset. You see, section 2 subsection 14 of the act defines it. It's a negative definition. It says capital asset means all property of any kind, but does not include the following. It does not include stock in trade, that is your inventory, does not include personal assets like my clothes, my furniture, utensils that I'm using, all of this is not included, and rural agricultural land. So these three are specifically exempted. Otherwise, all property of any kind is deemed to be a capital asset. But now, let me ask you an important question. Is cryptocurrency a capital asset? You can please put your answers in the chat box. But I want to understand from you, is cryptocurrency a capital asset? Yes or no? Yes, capital asset. No, not a capital asset. So I can already see a lot of people are saying yes, yes, yes. Some I'm getting many no's also now. So some people are saying no also. You can keep answering, but I'm just going to come back to this definition. So as you keep submitting your answer, if you want to change your answer also, you feel free to change it. But section 2 subsection 14 says capital asset means all property of any kind other than the following, and it lists out what is not a capital asset or what is not a property here. Now interestingly, it would appear that it is a capital asset, correct? Because it says property of all kind, it does not exclude your cryptocurrency. So your Bitcoin is not excluded. So it seems to me that if we go as per the definition, it definitely is a capital asset. But this is where the Income Tax Act is little funny, where it turns to differ. Now it says property of all kind. What the critical point is cryptocurrency a property at all? Is it an asset at all? There is a view, and this is the view taken in India, that it is just an algorithm. It is not a property. It is an algorithm. So because it's an algorithm, it means it's not a property. So forget the question of whether it's a capital asset or not. But ultimately, if I have to answer this question in the latest development, so many people have said yes, so many people have said no. In fact, Chandresh sir has put a capital N. No, it's not a capital asset at all. How can you even ask this question, Abhishek? So, so when that's the background, whether who is right, who is wrong, I can say both of you are correct. All of you are correct. All of you are also wrong. And I'll tell you why. The reason is the way your cryptocurrency is taxed does not matter which head of income it is at all. It does not matter at all. Because listen to this. If anybody has a profit on transacting cryptocurrency, Bitcoin, Dogecoin, whatever coin you want to call it, if you have a profit, then the entire profit is going to be taxed at a flat rate of 30%. So maximum marginal rate, it is going to be taxed at. Somebody said no voice. Am I audible? Audible.
Yes,
okay.
sir.
Okay. Thank you. Thank you. So I request Pankaj sir, maybe you can just adjust your speaker or earphones. So if you have a profit, it is going to be taxed at the highest rate. No benefit of expenses, unlike other capital gains where any expenses, brokerage cost, interest cost, anything that I am having, nothing can be adjusted. Suppose it is a loss, you cannot set off the loss. Now I have one cryptocurrency. Let's assume I have a Bitcoin. I have another cryptocurrency, maybe Dogecoin or something else. One I'm having gain, the other I'm having loss. Can I set it off? That also you cannot set it off. They're saying it has to be the same cryptocurrency. Only then you're allowed to set off a loss. If it's a different cryptocurrency, you are not allowed to set off the loss. So it has to be the same cryptocurrency. Only then you can set it off. Okay, fine. I can't set it off against some other currency, but can I at least set it off against other heads of income? That also they are saying you cannot set off your loss against any other head of income. So therefore, if I have a profit, taxed at the highest rate, maximum marginal rate, 30% plus surcharge, whatever. If I have a loss, sir, that's your loss, sir. We cannot do anything. This is the government stand when it comes to your cryptocurrency. In my view, it's a very draconian stand because profit alone you are taxed at the highest, but loss means you forget it. It's a dead loss. It's a waste. You cannot do anything with it. Seems highly unfair. And frankly speaking, I think the reason this is because the government does not know how to handle cryptocurrency. So they want to minimize people transacting in it till they figure out what to do. So it's just a restriction for people to transact more than a tax thing. But essentially speaking, it is which head of income does not matter at the end of the day, because it is telling you how to tax the income. It's a fixed rate if there's a profit. If there's a loss, it is telling you how the loss cannot be adjusted. It's a waste loss. If there is any transaction beyond the specified limit, it is telling what is the TDS. So whatever head of income you're going to offer, it does not matter, because essentially you will have to fill a specific schedule. And the new ITR form, which is going to come, a single ITR form is now going to be launched. We are all used to 4 or 5 ITR forms being there, but now you're going to have a single ITR form. And in that single ITR form, you are going to have a separate schedule for virtual digital assets, or what they call VDA, in which you have to specify the nature of the currency, the nature of the transactions. All of that has to be brought out in that schedule in the new ITR form. So it will itself populate what head of income needs to go there. We need not know. It does not matter. Forget, we don't have to be intellectuals to argue, sir, it is capital. No, it is algorithm. It should be others first. Does not matter. It does not matter, because all that matters for us and what we are going to be advising our clients is only this 115 BBH, which tells you how it needs to be taxed. And every client of yours who's dealing in cryptocurrency is only dealing in losses today. So you will be advising them that it's a waste loss. Please do not sell it. Please hold it till the price goes up. That's the best advice that we can all give as professionals today, because cryptocurrency is right now on a free fall. Even the share market has crashed. So the cryptocurrency, we need not ask, it is falling even further. Next important concept is the period of holding. And I think it's a very, very important concept to know what is long-term, what is short-term, because only if you can determine what is long-term, what is short-term, ultimately, you can find what tax rate to, apply on it. Now, most people are familiar with this. Earlier, there was a 2 slab structure beyond 12 months, less than 12 months, sorry, beyond 36 months, less than 36 months. Now there's a three slab structure. If you have, earlier it said financial assets. If you have any financial assets, then the period of holding is 12 months. Now that has been modified to what we call listed equity shares, equity oriented mutual funds, and zero coupon bonds. That is only for 12 months. If you're holding any unlisted shares or removable property, then that is 24 months or 2 years. And any other capital asset is now going to be for 3 years. The interesting point here is if you hold, let's say, a land or a building, for it to become long term, it is enough if you hold it for 2 years. It's a good thing. Earlier it was 3 years. Now they've reduced it to 2 years. But unfortunately, what the government has done is when they have modified this provision, there is a contrary provision under section 54 and 54F, where they say when you reinvest in a new asset, the new asset should not be disposed of for a minimum period of time. That minimum period earlier was 3 years, because it takes at least 3 years for an asset to become long term. But now they have not changed that to 2 years. While the period of holding has been reduced from 3 years to 2 years, the period you have to hold the new asset under 54 and 54F has not changed. That still remains 3 years. So unfortunately, I don't know whether it's a drafting error or whether it's a deliberate error, but whatever it is, unfortunately, period of holding maybe 2 years, but if it's a new asset, please remember, even though it is long term, you have to hold it for 1 more year. Otherwise, it will be taxed. Whatever exemption you claimed will be brought to tax again. Now, coming to this period of holding, I have one question. One person is a father, he purchased a property in 1998. The father dies in April 2022, and he has an only son. The only son inherits this property. It's a family property. The father, with great efforts, he purchased this property. And the son, after he inherits it, next day, he decides to sell this property. Can you tell me, will it be long-term or short-term? In the chat box, please tell me, this property for the son who is selling it, will it be long-term in nature or short-term in nature? Many people long-term. A few people are saying short-term. Others who are not answering are all saying it is medium term. Sir, what can be the examples of other assets? Gold, silver, diamond. I don't understand. So the question, so sir, maybe you can just rephrase it and then I will take it up. So majority of the persons have said long term. A few people have said short term. Now, long term is the right answer over here. The reason being, specifically the act provides in certain scenarios, there's a proviso to this section 242A, which tells about period of holding, where it says in the case of any inheritance, a gift, a will, partition, or succession, the period of holding of the previous owner also will be included while determining the capital gains. But my dear friends, there is no change as of now in these provisions. But I don't know how many of you have been following the news, because you may have noted repeatedly various sections of the government, be it the revenue secretary, be it the finance minister or the cabinet or any other person there. Occasionally, once every month, you will hear a statement. There has to be rationalization of capital gains provisions. We need to change the capital gains provisions. It's too complicated. There is some complexity there, so we have to rationalize it. What is rationalization? What is this meaning of rationalization? Why repeatedly they are saying? It is just a code word saying they want to remove exemptions, they want to remove certain benefits which are there. So when they say it is so complex, that complexity is created by them only. So they want to remove it. Will it be beneficial? That remains to be seen. But you can guarantee that this budget on February 1st, you are going to have a major change in the capital gains provisions. It is going to happen. It is going to happen. So what does that mean? How does it have a bearing with what we are discussing today? The bearing is this. For a few years now, there has been discussions in the halls of the North Block in Delhi that inheritance tax can be considered. It's not confirmed. Don't go tomorrow say Abhishek said inheritance tax is coming. It is not confirmed anywhere. But there have been discussions, and I'm privy to those discussions, that whether they should bring it or not, they are discussing. So whether they should bring it on all assets or immovable property, should they bring it on a certain assets beyond a certain value? Those discussions are going on. And I can confirm with you, I have first-hand information that this budget, you're going to see capital gain rate changes. Will there be a change in how inheritance or a gift or will is taxed? We don't know. So if any of your clients are in that particular position where they have any inheritance or will or succession, etc., I would advise kindly ensure the transaction is done before 1st of February, so that at least before there is a change. If there is no change, great, no problem. We are all fine, safe. You can advise whatever you're doing currently, even next year. But if there is no change, if there is a change, and if they make a significant change over here, then please note how that transaction will be taxed will be substantially different. So therefore, anyone who is thinking of it, who has plans, it is better you advise them to go ahead and finish the transaction before 1st of February. Now, Kishore Narayan sir has asked a very important question. He said, Abhishek, you said the period of holding has to be considered for the previous owner. What about the indexation? Now, in our example that we discussed over here, the property is purchased in 98, father dies in 22 April, son inherits it, and next day or next month he is selling it. Now here, okay, it is long term, so it is going to be taxed at a 20%. But when does the indexation benefit start for this person? Does it start from 98 or what we now say fair market value as on 2001? Does it start from 2001 or does it start from the year he actually gets it in the hand? A or B? A means from 2001. B means it's coming from the day he gets it in hand. So once again, you can see a variety of answers again coming. Some people are saying it is 2001. Some people are saying when they get it in hand. But majority of the persons are saying 2001. And 2001 is the right answer. The law as of today, the moment your period of holding is confirmed from the date of the previous owner, even the benefit of indexation is also confirmed from the date of the previous owners. It is presumed in law that you are holding the asset from that date. It is not a question of whether, okay, I got it only today, so it's long term, but then indexation I can take today. No, the presumption is as if you yourself bought that asset as on that date. So that is the presumption when it comes to this period of holding of the previous owner in these specific scenarios that we have put over here. Now, transfer of capital asset. I'm not spending too much time on this because these are all things that most of you will be familiar with. So I want to discuss a very, very interesting, controversial topic, which is agricultural land. Today, everybody and their mother has agricultural land. Anytime you see an asset being sold, client will come and tell you, sir, agricultural land, sir, I sold agriculture. Actually, it's not agriculture. It will be in the city or corners or outskirts of the city, what we call today. Let's say it is agricultural nature. We got Tahsildar certificate. We got this person certificate, that person certificate. So now let us understand what is agricultural land. We started off with the definition of what is a capital asset, which is section 2, subsection 14. I told you it's a negative definition. It is a negative definition. Now, I specifically said in that exemption, what is not a capital asset, rural agricultural land was exempted from it. So what is this agricultural land? Now, essentially, you have a slab rate. You have to measure whether a land is agricultural land based on two parameters. One, the distance it is from a municipality or a corporation or a board, cantonment board. One category, that is. Second category, the population. What is the population of that specific municipality or cantonment board or that area where the land is situated in as per the most recent census? Now, as far as the distance is concerned, let me ask you one. How will you measure the distance? Now, I go from point A to point B by my car. When I drive, it shows my odometer says that I have traveled more than 15 kilometers. Is that enough to say it is 15 kilometers away? Whatever I have traveled in the car? Or is there something else? There is something else when it comes to this distance. They say that you have to measure it from an aerial measurement, how the crow flies. So a bird's eye view, as rightly pointed by Hiren sir in the comments, it is a bird's eye view, or what we say, how the crow flies. So how you drive on road, there may be take diversion, you have to drive around the mountain and go, or you should go through an underpass and you have to go, or you have to go through our Mumbai bridge is there, so you have to go by the bridge and go. All of that it will not see. They'll see how a bird flies. If the crow flies straight and can reach the point, then that is the measurement they will take it. No matter how impractical it may be, that is how we measure it. So next question somebody has asked is how I will measure it, sir. Do I have to take a helicopter and fly and see? That's not required at all. You can use Google Maps today. Google Maps itself, if you see point A to point B, the measurement comes out. So it's very simple today, not like how it was maybe 15, 20 years back. So it's very simple. Use Google Maps to see the distance. But ensure it is not the road distance. You see only point A to point B distance. That is point number one. Second is the population. As I told you, the population has to be measured as per the most recent census which has taken place. Now, ideally, the census should have happened in 2021, but COVID happened, and there are a lot of other reasons why it could not be done within time. So, as of today, the most recent census in India is 2011 census. So, you have to use the 2011 census to see what is the population of the place. So, if it is more than 10,000 or whatever the specified slab rate to measure it, then in that case, it will be deemed to be either agricultural land or not. Now, here is where the important point comes in. Because as far as the Income Tax Act is concerned, my dear friends, it has only those two criteria. It does not have anything else. But let me ask you some questions and maybe you can answer it. I have a land that complies all the conditions that we just discussed. So therefore, am I eligible to claim it is a rural agricultural land? It is beyond 8 kilometers, population is less than 10,000. Is it enough? Now, is it an agricultural land? Yes, no? Yes. Majority of you are saying yes, 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 yes. So I agree. Now, let me ask a follow-up question to that. It satisfies all the conditions. I'm adding a new condition. I'm saying there is no agricultural activity at all taking place there. Now, it is a land beyond 8 kilometers, less than 10,000 population as per latest census, and there is no agricultural activity taking place there. It's a vacant land, but no agricultural activity. Can I still claim agricultural? Agree? Yes. Majority of the people saying yes still. Because Act is saying, no, Act does not say agricultural activities has to take place. Now, let me ask you a third condition now. I am saying it is more than 8 kilometers, population less than 10,000, but it is not vacant. There's manufacturing activity happening there. I have given it to Hyundai factory. At a Hyundai factory, you make cars, man. Go ahead. It's a huge place. It's agricultural nature. You make cars. So you go there. It's they are manufacturing cars in that place. Is it still agricultural? Chandresh sir saying, no, it is not agricultural. Then how you said the previous time it was agricultural? Because the Act nowhere says that if you leave it to Hyundai factory, then you cannot claim it as agricultural. Act still remains the same, beyond 8 kilometers and less than 10,000 population, which I'm still satisfying. But then when I say manufacturing is happening, immediately everyone is pulling back a little bit. They're saying, okay, how they will take agriculture? It seems to be a little unfair to do that. So therefore, I have another question also. And before I tell you what is the correct answer to all of this, I want to ask that other questions. Now, it is really agricultural land, and really agricultural activities are happening. But what happens is I have a very big family. I have 7 or 8 children. And what I am doing temporarily for temporary purpose, I'm stopping all the cultivation and I'm converting it into a stage area so that I can have the wedding for all the children. I want to get them off married this year. So I'm converting it into a wedding area, a temporary structure, everything is done. All these weddings happen, very good success, huge crowd comes. One real estate developer happens to be driving in the area and he sees, oh, wow, what a lovely land. So many weddings are taking place there. I want to buy it and make it into a wedding hall. So he comes to me and says, Abhishek, I want to buy it. I said, okay, sir, sold. So I sell it. Now, can you tell me, is it now in this scenario, is it agricultural land or not? Is it a capital asset or not? Please note that wedding is only for my children. I have not made any commercial money out of it. So is it agricultural land? No, it's not. It is still agricultural land. So you can see a lot of divisive answers which are coming over here. Now, before I answer the question whether yes or no, I have to talk about probably one of the most, I can say, one of the most irritating decisions that is there today. Because if you are dealing with agricultural land with the Income Tax Act, or sorry, with the income tax authorities, if any assessment is going on, I can guarantee you every single case that you are handling, every single assessing officer will quote only this case, Sarifa Bibi Ibrahim. Now, before that, somebody has a question. Hitesh Ji is asking, asset is not falling in the specified category of period of holding. Should be 36 months. Correct, sir, but it's only for capital asset. Agricultural land, if it is not a capital asset, period of holding does not matter. Only if it falls in the definition of capital asset, will you check whether period of holding applicable. In this case, it will be 24 months if it is deemed to be a capital asset. Now, coming back to what I was discussing, which is the Sarifa Bibi Ibrahim. Every single case that you handle with the income tax, the assessing officer will quote this case saying, as per Sarifa Bibi Ibrahim, as per Sarifa Bibi Ibrahim, they have said this, they have said that. What is the Sarifa Bibi Ibrahim, what they have said? You see, it's a old age old 1993 decision, I can say, where the Supreme Court laid down certain conditions. It laid down almost 18 conditions. What are these conditions? I'm not going to read all 18 of them, but I'm going to try to tell you what are the seriousness of these conditions. First condition, whether the land is classified in the revenue records as agricultural. That's the first question. So therefore, Hyundai factory happening, 100% it will not be classified as agricultural. They'll say, get lost. It is not agricultural. Second, was the land actually used for agricultural purposes? Now that's an important question because it can be a Hyundai factory. But if I go tell that Tahsildar, sir, I'll give you a car, sir. You tell me that you give a certificate saying it's agricultural land. So he says, okay,
Sir,
fine.
your voice
I
is
want
not.
a Hyundai car. If you give me, I'll give. Oh, okay, sir, done. So he gives a certificate. It is agricultural in nature. So I bring the Tahsildar certificate. See, Tahsildar has told me it is classified as agricultural, but really it is not. But what is the Supreme Court saying? You have to check how it is used. They're not taking only mere classification. They're saying check how it is used also. Third criteria they're saying, check the land, whether it is used for a stopgap purpose or whether it's a temporary purpose or a long-term purpose. Now that example I gave you of that wedding hall, it being converted temporarily into a wedding hall, it is temporary. I was really cultivating on it. It is really agricultural land. For my own family only, I converted it. So it is a temporary stopgap arrangement. What the next fellow does with it, I have no control. He builds a big wedding hall. He builds a 16-story apartment structure. I have no control. So you cannot come and tell me my land is not agricultural because of what the next person does with it. At the time of my sale, when I sold it, substantially all the time agricultural activities only were going on there. In that case, it is agricultural. Next, they are saying, see the income derived from agricultural operations, whether it is rationally proportionate to the investment. Now, this is a very important one. And I don't know how true it is. I know the auditor of a lot of the Bollywood celebrities from Bombay. And there are repeated newspaper articles or rumors that some of the most leading actors are huge agriculturists. They have huge swaths of land across the country, which are agricultural, rural in nature, and they make a lot of money when they sell it. Now, the reason they have put this, whether the income derived, see the rationality. I can buy an agricultural land for 15 crore rupees. 15 crore rupees, I am buying agricultural land. And I'm earning from my agricultural activities 3,000 rupees per year. I'm getting 3,000 rupees from selling of coconuts, or even 30,000 rupees from selling of coconuts. Now, here what the Supreme Court is saying, check whether a rational person would do that. To earn 30,000 rupees, whether he will spend 15 crores and buy a land and earn 30,000 rupees. It does not seem like what a rational person will do. So see the sensible appropriation, whether it makes sense. So this also has one very, very interesting implicit condition. And this implicit condition is checked by every court today. They are saying if you have an agricultural land and you claim it to be agricultural in nature,
then agricultural activity should have taken place on that land. Not only that, if you offer it to income year on year, it reinforces that it is agricultural. So if any of your clients have, better you tell them offer some money. They'll say, sir, what I'm not getting any money from it. Still better, sir, you still offer. Anyway, it is exempt. Only for tax slab purpose it is considered. But the income itself is not taxed. The benefits of offering it is outweighs not offering it. So they'll say, better you offer it to tax. It's better advice that you can give your client. Next, look at all the what and all conditions the Supreme Court has put. Whether the land is situated in a developed area. Check the characteristics of the what the lands are, the adjoining area. So they're saying, oh, Hyundai factory is there right next to it. If you see here, Ford factory is there. You see over there, Mitsubishi factory is there. So all the top, all these buildings surrounding it are all factory buildings. They're all huge developed buildings. And this person in the middle of it is saying, my land alone is agricultural. It seems unfair. So you should not allow. Then they're saying, see, then some Bombay Tenancy Agricultural Act. I don't know what that act is, but you may be familiar, but they're asking to check that. And they're saying whether an agriculturist, look at the last one, check whether an agriculturist would spend that money to purchase the land for that value. So if I'm a farmer, would I spend that same amount that this person, whoever the assessee is buying that land for? Then in that case, you have to see whether it is agricultural or not. Now look at all these conditions. I can guarantee you one thing. If you follow these conditions, no land in India will be agricultural. It's impossible. Nothing will be agricultural. At least one of these conditions will defeat it. But this is the most important point I want to mention. After spending so much time on explaining this decision, these 14 points which were laid down in this decision are indicative only. They are not binding provisions. They are indicative provisions. That means if I do not follow the provisions, does not automatically make the land a non-agricultural. They are telling the income tax, do these tests, check these tests. If all of these tests are satisfied also, you cannot say it's non-agricultural. If nothing is satisfied also, you cannot say it's agriculture. It is only for you to help your professional judgment. So ultimately, it still comes down to your assessing officer who decides. But they are laying down some tests saying these are indicative. If you want, you follow. So if you want only. Luckily for us, most of the courts are not following also. they have their own way of following it. But I can tell you certain common conditions that you can see is check the revenue records. The revenue records should classify it as agricultural. So not only 8 kilometers, not only population, revenue records should specifically classify it as agricultural. That's the third condition. Fourth condition. This is a little bit conflicting because some decisions say that agricultural activities should be carried on. Many decisions are there which says agricultural activities also need not be carried on. It's okay if it is not carried on. But by and far, substantially and increasingly nowadays, most of the latest judgments, if you see, they are saying agricultural activities should be carried on. So that's the fourth condition. This is all an implied condition. The real conditions are only two. 8 kilometers, 10,000. That is 8 kilometers from the distance, 10,000 population. These are the two conditions only as per law. The other are all judge evolved conditions. Third one, classification as per revenue records. Fourth one, agricultural activities being done on that land, actual agricultural activities. Fifth one, as I told you, try to offer it in your return of income on a regular basis, and then you'll be able to claim it. Sixth condition, and this is a very important condition, most people don't know. So I handle a lot of appeals, and even at Bombay ITIT, I've handled for some CAs there. What I can tell you is one common thing that I've seen from many chartered accountants is when there is agricultural income, the way it is calculated, the way it is disclosed, everything is done properly by most CAs. But one thing they miss out is just because you disclose it as agricultural income does not mean they need to accept it. There is a requirement to maintain separate books of account for the agricultural activities. So you must say sale of crops, sale of coconut, sale of XYZ things. We have sold it for this value. These are my costs. I paid wages to this fellow. I paid so much for fertilizers. I paid so much for seeds. All of these are things that I have to maintain. I need not necessarily file it with my return. It need not be filed with the return, but I need to maintain it. Only if I do that, will your agricultural income be accepted as exempt? Otherwise, they will add it to other sources and tax you. So please note, that's a very, very important requirement. So implicit condition for you to claim it is not a capital asset is for you to have offered it regularly in your return of income also. You can still claim agricultural without offering it, because if one of your associates is selling it today, you cannot go back and revise the earlier returns. So you can still claim it as it, but it helps if you have been regularly offering it to tax. So these are certain important conditions. And practically one more thing that I will tell you to do is ask your client, if it is actually agricultural, to take photos of it. He has to take photos of the land. The reason being, very often by the time the case comes up for scrutiny, it's at least a year or 2 years or 3 years after the transaction has taken place. I sell it today, I file my return next year. And then after that, by the time the case is taken for scrutiny or reopening or assessment or revision, it's almost 3 to 4 years down the line. Of course, now they can reopen up to 10 years also. So it can be 10 years later also. In such a circumstance, the position of the land as on that date, nobody will be able to ascertain. 10 years back, what was the position? It is agricultural. Today, what is there? Sir, you can see 16-story building. You go next to that. It's like Gurgaon, right? You know how Gurgaon is in Delhi. It was just barren lands. And all of a sudden, DLF came in, and in a couple of years, it has become cyber city. By the time the scrutiny case came up for all those farmers over there, the lands, that entire area is completely transformed. So I go for a photo of the land. I can't take a photo of the land. How will I establish really it's a vacant land or really it's agricultural land? It is impossible for me to establish at a subsequent date. So I would highly recommend anyone who has agricultural land, and this is what we tell for all our clients, take photos. Yearly, once you visit or something, just to take photos, or the time of the sale, whenever you're selling it, just to take a photo of that property, whether it is plotted, how is the area near it. You know, sometimes you can take a satellite photo. Department is doing that now, where they're taking satellite photos to see whether really agricultural land or not. So these are certain things that practically you must do. The law will not tell you this. Only experience can tell you. And the number of cases I've handled, I can tell you for sure. If you're able to do all the conditions that I've just told you, you can confidently claim as exempt, and you don't have to worry at all at income tax proceedings. Either at CIT appeals or ITAT, you will get the relief. You need not even go to High Court. Now, I have a couple of questions relating to this, and I'm going to answer. So anyone has any other questions relating to agricultural land, you can put it in the question and answer box or in the chat box, and I will take it up. Now, Kishorji has asked, can we offer receipt of cash as agricultural income? How can I say on a platform like this? I can only say if it is agricultural nature, you can ask it, because agricultural activities, you can accept cash. There's no problem. There's no restriction on that other than 269 ST. That restriction is there no matter what transaction it is. Even if it is a gift, 269 ST is still applicable. Please note, 269 ST is like an overarching provision. It is like overseeing everything in the Income Tax Act or any transaction. So if I do any transaction, even gift, even agricultural, anything it is, even if it is exempt, I cannot do it in excess of 2 lakh rupees. So ensure it is within 2 lakhs, you can still do it. It is not taxable. So if rural agricultural land is sold to a developer, whether taxable under section 45IA. This is why specifically Arunji, I gave that example, where at the time of sale, it is agriculture. I have no control what the next person is going to do with it. If he wants, he can continue agricultural activities. If he wants, he can do plotting, he can leave it vacant, or he can build a multi-story structure. In your case, the developer happens to have built a large building there. Do you have control over his actions? No. Multiple decisions are there. That where, when at the time of sale, what is the position of the land, that has to be evaluated. If he satisfies my 5 test, whatever I told you, Abhishek's 5 test, don't see Sarifa BBM on. What I told you, if it satisfies those 5 tests, confidently you can take that it is rural agricultural land, it will not be subject to tax. So you need not see what the next person is doing. I hope that's clear. Great. So now we'll proceed. You can keep putting your questions. I will still take it up. All right. We'll go to the next one. Computation of capital gains. So this is the broad structure of how you compute your capital gains. And all of us are familiar with this. If it is short term in nature, your sale consideration minus cost of acquisition, any cost of improvement, less any expenses in connection with the transfer, important point, and whatever is left is your taxable short-term capital gains. In terms of long-term, you have an additional indexation benefit, and after that, any exemption under Section 54, etc. Now let's start with the first one, which is sale consideration. Some critical points relating to this. Now, Section 50C. 50C is an important section, and of course, it was introduced to curtail your black market transactions or your cash transactions. So, what does 50C say? Irrespective of what sale consideration you are receiving, if it is below the guideline value, then the minimum sale consideration for the purposes of Income Tax Act, the sale consideration as per 50C will be the guideline value or the circle value, whatever you may call it. Now, here, let me give you an example. I happen to have a land which is in the heart of the city. Let's assume I have a land in Churchgate, right in the heart of Churchgate, next to Asiatic. The LIC building is there. It's over there. I have a triangle shaped land. This land is a highly cursed land. I am never able to do any activities on it. The soil is so weak that I cannot build more than the ground floor. Electricity connectivity is terrible. Water connectivity is not at all there. I have to buy water through metro tanks every time. And it's a very, very unlucky house. Any person who's moved into that house, they have become financially bankrupt. So now can you tell me, is the guideline value of the same land, it is equal to all the other properties in Churchgate? But is the market value reflective of that, or it will be lesser? Definitely it's going to be lesser. I think we are all on par with that, because practically there are so many challenges with that property. It cannot even be possibly close to the market value or the guideline value of the property. It's going to be much lesser. So when that is the case, 50C is going to harm me. It does not help me. It does not help the department. It's harming me. So do I have any remedy? Yes. Two things I have. One, I can make an application to the sub-registrar, where I go and tell him, I don't know what is the form in Bombay, but in Chennai, you have a form 9, where if you give that form, you can make an application to the commissioner or the sub-registrar, and he will verify the facts. He will put a person who will go and check whether the calculation is correct, etc. Now he'll determine, yes, the guideline value is inflated. This should be the guideline value for this property. So you can do that, option 1. Option 2, you can make a reference to the DVO, or what we call a valuation officer. This valuation officer, he will examine and he will evaluate and see whether the guideline value is correct or it should be lesser. Now here, let's assume I'm selling the property for 50 lakhs. Guideline value is 60 lakhs. The DVO comes and says the value of the property is actually 45 lakhs. So in this case, what is the sale consideration I have to offer? Is it 45, 50 or 60? Here I have to offer at least the minimum of what I've received. So when I've received 50, even though he values it to be lesser, the sale consideration is minimum going to be 50, no questions asked. Next point, he comes back and says the value of the property is 55. I have received 50, guideline value 60, he comes and says it is 55. Then in this case, the sale consideration becomes 55 because the valuation officer has come. What if the valuation officer comes and says, I've done the check, the value of the property is 75 lakhs. Now in this case, what value should I adopt over here? Is it what I received 50? Is it the guideline value of 60? Or what the valuation officer is coming and saying 75? As most people have very correctly put in the chat box, it is a 60 value, which is the guideline value. So it can never be more than the guideline value. Whatever is beneficial to the assessee. This is a beneficial provision. So whatever is most beneficial to the assessee, either the DVO value or the guideline value, the most beneficial value can be adopted as the cost of, the sale consideration over here. Now, let me ask you a follow-up question over here. Now, I have to file my return of income in year 0. The return is taken up for assessment in year 3, correct? So when I'm filing the return, I have to anticipate what that valuation officer is going to tell is the value, correct? Because when I'm filing, I'm saying I have to offer, if my sale consideration 50C value, I have to type it in the ITR form. So I have to put what sale consideration I am adopting. So I need to see what is the accepted sale consideration. So at year 0, I'm going to evaluate and so this is a very important point being. Let us assume I have put one value, case is taken up for scrutiny. During the course of the scrutiny, assessing officer says, what is this? Guideline value 60 lakhs, you are offered only 40 lakhs. What's going on? And I'm saying, sir, no, sir, actually, really, there are a lot of problems in the property. And, it's not truly the market value. I objected to your 60 lakhs, sir. He says, nothing doing, you're a liar. Look at the difference. 20 lakhs is the difference. I'm going to add it. Now, here, whenever there is a substantial difference between the guideline value and the value offered in your return of income, wherever the assessee objects to it, then a reference to the valuation officer should be made. Now let's assume in the course of the assessment, this is all happening in December, time barring date is there, 31st December is the time barring date, and I'm saying, no, I object. It has to be checked by a valuation officer. By the time a valuation officer comes and checks all this, it's going to take at least a week or 2 weeks time. And the time to pass the assessment order would have elapsed. So assessing officer says, you are doing it deliberately to cheat me. You are a cheater, you are a fraud. You are trying to ensure that the time barring date goes. Then only you are trying to, offer it to tax later. Now here, the critical point is, whenever an assessee makes a request that a reference to be a valuation officer should be made, the assessing officer is duty bound to make the reference. It is not at his discretion. He cannot say that no need, sir. I think it's a fraud case, this one. So let us not make a reference. He has no discretion whatsoever. So if you object to his valuation as per 50C, if he objects to your valuation, then a reference to a valuation officer is mandatory and not discretionary. If he passes an order without making reference to the valuation officer, either it can be quashed in its entirety or another opportunity can be done to make the evaluation. So please note, anytime you have a dispute over this 50C value, please put one line in whatever submission you're doing or in the income tax portal whenever you're answering. Just put something saying that we object to this, we request a valuation to be done. The moment you put that, you will automatically get a relief under this provision. So even if he passes an order on a legal ground, on a technical ground, you can win the case in the appeal. Forget merits and all. You may be really a liar also, but on a technical ground, you can win the case very, very easily. Now here I saw a couple of questions, so I'm just going to take that up. Sir, if VAT is collected by the builder from us now for property purchased in 2005, is VAT deductible from sale consideration? Is there any case law? Why will the VAT be deductible? You will add it to the cost of acquisition. No, sir. Whatever year you are paying it, it is whatever cost to acquire that asset or cost in relation to that asset. So therefore, you will add that to the value. You cannot deduct it from the sale consideration. You can add it to your cost of construct or your cost of acquisition or your cost of improvement. I'll tell you another example here. Your assessee happens to hold a land, and the land, whatever he's inheriting, is from his father, is there for so many years. All of a sudden, the government or the corporation come and say it is improper. You need to regularize the land, otherwise we will seize it. So he says, for regularization, I have to pay, 10 lakhs or 20 lakhs to regularize the land. So he pays that amount. Now here the question comes, the character of the land has not changed. It is still a land. Whatever land it was before this regularization also, same position. After regularization, same position. But it's a cost of improvement. It is a cost of improvement, because to have a clear title of the land, you are incurring a certain expenditure, which goes to increase the value of the land. So therefore, it is a cost of improvement. So the year you are paying that regularization charges can be added to the cost of acquisition for that year. So you'll index it from the year of the payment. So that's a very important point that you need to note. It cannot be deducted from the sale consideration, however. So if DVO values at 55 lakhs, is 10% variation available? 100% Adi. It is 100% there. There's no question at all. 50C value will be determined to be whatever the DVO values, and then your 10% discretion will come over there. Whether it's a safe harbor rules of 10% variation can be measured from there, it can 100% be measured from there. Now here, since Adi asked that, we can ask one very, very interesting thing, because this is a very recent decision that came from Pune, where in this assessee's case, so this 10% or what we call the safe harbor rules, I think was brought in sometime in 2015, if I'm not wrong. Now in 2015, when they brought it, year onwards, 2015 onwards, people see whether it is 10% difference means they'll say, okay, it's within 10%. So I need not adopt 50C value. You can accept my value, whatever it is. Now, 2016, Kishore sir says, thank you, sir. So one person happened to have sold the land in 2012. It was reopened 6 years later, and the assessment went on after 6 years. And of course, a COVID time, so extension, etc. So it came up to the ITAT very recently. So Pune ITAT, what he did is he said, the land sold in 2012. As per guideline value, it is 100 rupees. I have sold it for 95. It is still within 10%. Department said, what is this nonsense? 10% came only in 2016 and you sold it in 2012. How can you claim the 10% today? So the ITAT have held, the Pune ITAT have said, this is a beneficial provision. So therefore it should be applicable retrospectively. So even though the law was not there at the time of the sale, you have to still give them the benefit of that 10%. So I think it's a very useful decision. And we have to thank the Pune tribunal for giving that decision. So we can take the benefit of that. So you can take the benefit of this 10%, even though the provision came in 2016. Whatever happened in the earlier years also, you can claim this 10% differential benefit. So cost of acquisition, I think these points we have discussed already. I'll just check the chat box if there's anything which has come. So in case of redevelopment of society, there's an agreement among the members, society and developer. Developer offers different consideration to members and society. Whether members are mandated to follow 45(5)(a) as it contains, notwithstanding anything contained in 45(1). I think Arunji will probably take up this question in the end because it's taking me some time to absorb it. So I don't want to break the flow of the session. So we'll take that question in the end and you can put it. Aziz Ji has put, in case of compulsory acquisition, how to go about the exception compensation under, okay, that's again, we will take that question also in the end because that act is a very interesting and act. So we'll take that question at the end. Okay. Now I have one interesting practical thing. Bonus shares. You see, let's assume I got a Reliance share in 1994. I purchased in 1994. Reliance announces a 2:1 bonus. They announce, they say if you hold 2 shares, you get 1 share as a bonus. In 1998, I decide to sell all my Reliance shares today. What is the value of a bonus share normally? It is 0. Because whatever I've got as a bonus share, I have not paid anything for it. So the cost of acquisition is 0. But now, after tax has been payable on long-term capital gains on sale of shares, we now can take the benefit of indexation also. So when we do that, it says you have to take whatever is the fair market value as on 2001 or purchase value, whichever is higher. So can I, for bonus shares, which I've got for 0 rupees, take the fair market value as on 2001, or should I take it as 0 if I sell that share today, the bonus share? So will it be 0 or will it be the fair market value as on 1/4/2001? Can you tell me? Fair market value. Okay. Some people are saying 0 also. So majority of the answers says fair market value. But some persons have also answered saying 0. Now here, that's the interesting point. It's very beneficial to the assessee. The moment they brought it to tax, then it's like any other asset, which means for any other asset, if I take the fair market value as on 1/4/2001, even the bonus share also gets the same treatment, even though the value is actually 0, the cost of acquisition 0. You can take the FMV as on 1/4/2001, you can index it till date, and you can take that benefit also. So therefore, that's a very hugely beneficial provision for you. 112A, we're all familiar with. I'm just skipping it because for want of time, I want to cover certain important provisions. Okay, this taxation of gifts, I think today it's a pretty settled law, but when I made this presentation, this is one thing that we are constantly representing. And in fact, from the All India Taxpayer Association, we have raised this as a point where 56(2)(10) is a highly unfair provision. Where after great difficulty, I am identifying a seller who's selling the property at a value lesser than the guideline. Fire sale, he is doing it. So property worth 60 lakhs, he is selling it for 40 lakhs. He's saying, I will offer 60, sir. I just need 40 lakhs immediately. So I say, okay, fine, I'll buy it from you. So I give 40 lakhs and I buy the property. Now government is coming and telling me that difference between 40 and 60, that 20 lakhs difference, it's like a gift to you, Abhishek. So you have to offer it to tax and other sources. Why it's a gift to me? Anyway, whenever I sell it, my cost of acquisition will only be 40. You are coming and making some notional value and you are saying I should pay the tax on. And why I will go to a DVO, ask them to refer to the DVO, etc. as a buyer. It will never happen. In moment it is getting at a good price, I will buy it immediately. But once again, this is where the complexity in the income tax provisions come out. So the Act now says the buyer of the property also, the difference between his purchase price and the guideline value now has to be offered to tax. This flies against the face of what in Income Tax Act we say, possibility of performance, where if I don't have the funds to pay the tax, what will I do? It's a notional value and you are taxing me at other sources means you'll be taxing at the highest slab rate, because capital gains means minimum the value of transactions is 5 lakhs, 6 lakhs at least. And here I am being taxed at more than 30%, I'll be taxed. So this is very, very unfair, I feel. And that's the law today. And we have made a representation that this should not be done. Whether it will be accepted remains to be seen. But that is the position of the law. So let us come to probably the most important part of the presentation, which is your capital gain exemptions. And this is where you really can make a huge difference for all of your clients when it comes to your planning of your taxes. Now, traditionally speaking, you have multiple provisions for exemptions, but only 3 provisions are critically used by all assessees: Section 54, Section 54EC, and Section 54F. Now, Section 54 and 54F are almost similar. 54 says the asset sold must be a residential house. This is an important point. A residential house must be sold. It must be long-term in nature. And the capital gains from this house needs to be reinvested 1 year before or 2 years after in a new residential house. So these are the only criteria for 54. Of course, there's one more criteria, which is that house should have been taxable under the head income from house property. This is a very important one because many people have been asking. In fact, even yesterday in one of the WhatsApp groups, somebody had asked me a doubt saying that, sir, I have sold a right in my property. That is, I had a right to property before it was completed. I decide to sell it. So can I call the sale of the right as 54 exemption? Can I take it? Because it is a right to a residential house. It is long-term in nature. The new house is also a residential house. I have reinvested within 2 years. So therefore, can I claim it? But unfortunately, the condition a right will not satisfy is you could not have offered the right under income from house property. Only a completed house can be offered to tax under income from house property. So that third condition, most people don't realize, and they still go for this rights taxation, taking the benefit under 54. But you will be in for a rude shock because the law is clear. The Act says it should have been offered to tax under income from house property. So in case you have not offered a house for tax, at least in the year of sale, please offer it. If you do, then you satisfy this condition. Them coming and saying why you didn't offer in the earlier years, they can reopen and then put a notional tax or whatever. But to save capital gains tax, offer one amount in the current year at least as income from house property. Somebody has asked, what if it is sold through a power? Okay, now this is a good question. It's a practical question. I'll tell you why. This power of attorney transactions, and I had it in my presentation, but I skipped it because I thought it's too simple. But the point is, what is a transfer? Definition of a transfer under Income Tax Act: sale, extinguishment, demolition, all multiple conditions are there. There's one condition, the final condition. It's the part performance of a contract as per Transfer of Property Act. Now, this part performance of a contract has 4 conditions. Those 4 conditions, they say there must be a writing or an agreement between the buyer and the seller that they want to transfer the property. 2, substantial consideration is paid, at least 80%, 90% should have been paid, and I should have received possession of the property. In these cases, registration is a mere formality. It is not an actual requirement. So if you register the property, only then the sale is complete. You cannot say because essentially for all practical purposes, the sale has happened. If Jitendra and I, we are very close friends, I'm saying I'll give you the house property keys, you give me 90% of the consideration, we'll come to understanding. Whenever you decide to sell Jitendra, I will come and I will sign at the registrar. So let us not register. You will also save money. You can pay me certain half of that money as a consideration. I will enjoy that benefit. Whenever the third party comes, I will say, I will just sign the registration at that point. So both of us best friends, we agree. But essentially, house is given, possession is transferred, consideration has come, we have an understanding or we have an agreement to the effect. So therefore here, essentially he is the owner. Jitendra is the owner, no matter what. So therefore you cannot say, sir, see, sir, registration has not happened. Abhishek is only still the owner. He has to only offer it under income from house property. That will not happen. So therefore, even if it is in the nature of power of attorney, you will see the nature of that power. If that power gives you the unbridled right to transfer, dispose, and act on the property, possession over the property, and you have paid a consideration to that fact, then you can be considered to be the owner. But having said that, the facts and circumstances of each case will be examined. The reason being, this act of filling the consideration paid for the power is a relatively new thing. I think transactions which took place maybe 12, 13, 14 years ago and before that, people did not normally put a consideration for getting a power. So in those cases, a power agent cannot be deemed to be the owner, even though he has possession of the property. Ultimately, the owner is still the original owner. Because we'll take an example, and I happen to be, of course, our legal team at the office, and one of our clients who we are advising is facing this scenario where this assessee happens to be a very leading businessman in Chennai, and he and their family came to a settlement. They come from a very wealthy family, huge assets they have. So the next generation, there was some dispute, so they all came to understanding, saying, you know what, let us settle all the disputes between ourselves. You take this property, I'll take that property, you take so much gold. All that they came to understand. Now one of these persons who was part of that, as part of the settlement family understanding, they said, okay, we are giving you a power to this property. Whenever you decide to sell, you tell me, I will come and sign it. So he has got the power, and he is trying to find a appropriate buyer. He said, oh, we'll wait. We are not in the need for funds. I have a feeling the property value will rise. So he left it like that. Subsequently, just during the COVID time, the person who gave him the power, he died due to COVID. It was a very sudden death, and he died due to COVID. Now, what happens to the power? The power of attorney lapses because he has not bought it for a consideration. Even if you have bought it for a consideration, the power has to very clearly and explicitly state that you are the owner, whether you have registered it. A lot of things can be done. Here, the original owner, it went to their children, and the children do not want to sell the property. So they are not cooperating now. They are saying, we will not give you a power. We will not allow you to transfer. We will not come and sign. So there's a big legal issue that they are facing today. So as far as income tax is concerned, it is still ultimately only 20%. Sir. You have to see what is 100%, whether you want to have the opportunity to dispose or not. So most power of attorney holders today, they do not hold it for more than few years. So if the power of attorney is clear that you have essential possession, control, rights to dispose the property, and you have paid a consideration for it, and the previous owner has essentially relinquished all his rights on it through the power of attorney itself, that can be deemed to be a sale transaction. Even though there is no sale deed, even though there is no registration, it can be deemed to be a sale. Department will 100% take it as a sale. Department will 100% take it as a sale. It's up to you what you want to do and how you want to fight it out. And ultimately that only will determine the taxation. So that is how you have to go when it comes to your power of attorney. Now coming back to this 54 and 54F, I just told you the provisions for 54. Now 54F has three key differences from it. Under 54, the asset sold must be a residential house. Under 54F, any long-term capital asset other than a residential house. So land, gold, jewelry, even shares today, you can sell that and claim 54F. Next main change. They are saying new asset should be a residential house. New asset also should be a residential house, provided assessee does not own more than one residential house at the time of the sale. Look at this wording, very, very important. Does not own more than one residential house. Third key change, under 54, the amount invested has to be capital gains. Under 54F, the amount reinvested has to be sale consideration. The entire sale consideration has to be reinvested. If not, you can take only a proportionate benefit from it. So this is the key changes when it comes to your 54 and 54F, but otherwise it's almost identical. 54EC is slightly different, which is the asset sold can be any long-term capital asset that's immovable in nature, so land or building. And within 6 months from the date of the sale, I must put it in REC bond, NHAI bond. I think NHAI has been removed very recently. So REC bond or any other specified bond or notified bond. And maximum I can reinvest is only up to 50 lakhs. So if the capital gains is 1 crore, then up to 50 lakhs I can put here. Balance amount I have to put either 54, 54F, or I have to pay the tax on it. So the ceiling limit of 50 lakhs, that remains the same from when I studied the CA. They have not increased that limit. So that remains the same today. Now here is a very interesting case law that I came across very recently from the Bombay High Court. Now I am an assessee. I have paid an advance to purchase the house property as on 20th April 2012. Subsequently, I am selling my properties on 11th September 2014. Whatever property I paid advance for, I'm making the final payment and I'm taking the delivery on 22/7/2015. AO was saying you should have made the payment 1 year before or 2 years after. In your case, 1 year before ended on 11/9/2013. You have paid the advance on 24/2012. So I cannot consider that property. Have you done any other property? No, sir. So you do not get any benefit. The High Court held that the date that should be relevant over here is the final date of possession. Not only did they stop it there, they said when the final possession is taken, you can take the full value. Not only the value you're making at the time of the final possession, but even the advance that I paid in 20th of April 2012, I can take that value also and claim it under 54 or 54F. So why they have taken this position? There's one very old decision called Bajaj Tempo versus CIT. I'm sorry, I'm drinking a lot of water, but my throat is hurting. So I apologize for that. But just to ensure that there is no disturbance is why I'm doing that. So in 1992, there's a decision called Bajaj Tempo, where in this Bajaj Tempo, they said, you see these capital gains provisions, they are meant to spur the economy. So therefore, you should apply them very liberally. So it is meant for economic growth. So don't be hyper technical. Don't be too nuanced. Be liberal in the application. So this is one of the key decisions. You will see this quoted in almost all capital gains judgments, where everyone will say Bajaj Tempo, sir, Bajaj Tempo, sir, because they are saying that you have to be liberal. So why liberal? That is why your planning comes in 54 and 54F. I'll give you an example of one case. There was a Karnataka judgment called Gauli Mahadevappa. Now you can answer me this. Now we discussed 50C. Property sold for 50 lakhs. Guideline value is 60 lakhs. So sale consideration, I should offer 60 lakhs. We're all on the same page. But if I want to reinvest under 54EF, I told you I have to reinvest the entire sale consideration to take benefit of 54F. Can you tell me here under 54F if I need the benefit? Should I reinvest 50 or should I reinvest 60? If I want to take the benefit of 54F, should I reinvest the guideline value, which is the deemed sale consideration of 60? Or should I reinvest the actual sale consideration which I received, which is 50? So a lot of people saying 50, some people saying 60, some people are saying actual, so that actual means 50. So majority is 50. Now I can say both of you are right, because the Karnataka High Court says that you have to take what is the deemed consideration. They are saying you have to take 60 only. How can you take 50? The whole purpose of having a guideline value and doing this 50C itself so that you don't cheat the income tax. So you cannot take 50. It's assumed to be 60. So even when you reinvest, you have to take 60. Sir, where will I go for the balance 10? I have received only 10. I have only got 50. How can I reinvest 60 when I don't have the money to reinvest? So then they say, no, 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 you take a loan, you do whatever. That's what they say. But that's the Bangalore High Court. The Chennai Tribunal, and of course, more tribunals and more high courts today have held in multiple cases saying it is enough if you put the actual only. Bajaj Tempo, be liberal. You're taxed, 60 you have used for taxation, that is fine. But for reinvestment, where the act says you have to take the 50C value, it only says that you're taking sale consideration. Actual sale consideration is 50. How can you ask him to go and reinvest 60? So allow 50. So they are taking a more liberal stance over here and they're saying take 50 as the value. So that is a better beneficial condition. So we can take 50 as the reinvestment value over here. Now, there was another very interesting case though. Can I borrow and invest or should it be the same money? I'll tell you this example. It's a case that I handled at the Chennai tribunal. There happened to be a judge who was from Delhi and we were appearing for a case before him. And in this case, the case came up. Assessee has sold his property. He has received a few crores as sale consideration. His daughter happened to have got into Harvard. She got into Harvard. So he needed the money to pay the tuition fees, which ran into several crores. So he sold the property. Immediately he paid the fees for Harvard. He sold it sometime in December. January he paid the fees. And then by March, his business made the money and he reinvested and claimed 54F. Immediately, department took up the case. They said, this is improper. You're not allowed. He says, why? I've reinvested within 1 year. And, whatever money I need to do it, full sale consideration, I've reinvested. They said, no, you see, you have received the money in December. In January, you have transferred it to Harvard. It's not gone towards the property. So that's it. Your opportunity to reinvest is over. So this, of course, we went to CIT appeals. They just copy pasted the order. I went to ITAT. Now, ITAT, the judge said, can I borrow and invest? Or can I use the funds from something else? Or should it be the same funds that I received as a sale consideration? You say it has to be the same. How you got the money you put for Harvard, gone. You used your funds. You cannot claim 54F because whatever sale consideration you received, instead of reinvesting it, you spent it as expense. Now, this is where there's a very funny logic, and this is what I told him also. I said, Your Lordship, provisions of 54F and all came when cash transactions were the norm. So you are telling me, if I sell a property, I get the cash from the property, I put it in the safe, or I put it in a bank locker. And then subsequently, when I want to reinvest, I have to take out the exact same bundles. Is that what you are telling me? Suppose I take the bundles next to it, then it becomes invalid. No, you got the wrong notes. So you cannot. So it's incorrect. And various decisions have held that the color of money is the same. It doesn't matter whether it's gone for Harvard or this. Provisions are there. If you comply with it substantially, you should allow. You cannot say this fund has gone there. Therefore, you cannot get any other funds to reinvest. So that's completely wrong. It has to be very liberal in the application. So whatever money I can borrow and invest also, it does not matter. Furthermore, 54 and 54F, what do both provisions say? 2 years later or 1 year before. 1 year before also I can invest. If I don't even sell the property, where will I get the funds to invest? So if I'm allowed by law to invest 1 year before, that naturally means I'm using some other funds. No, I cannot use the sale funds because I have not got the funds yet. Sale has not yet happened. It's impossible for me to apply the funds that I have not received. And the law is saying that I can invest 1 year before. That automatically means I can borrow and invest. So it seemed very silly. And then luckily, even though he was for some reason, he was not convinced. Then we took an adjournment. It came before a different bench and we were able to win the case. But sometimes, just because they're a tribunal member does not mean that they will agree with the law. They may have their own views or their own experience. So that was a very funny case that we faced. Now, another very funny decision. This happened in Madras High Court. This is a very, very famous advocate. You may have seen him, Arima Sundaram. He's a Supreme Court lawyer. In his case, he happened to have a very old land, 1968, 1970s. He inherited it from his parents, and his land is just vacant. So he happened to sell a property, and he decided, okay, I will construct on this old land that I have. I'm going to construct on that land. So he constructed a property on the land and claimed 54F reinvestment I put. They came back and said your reinvestment is inadequate. They said if you want to cover the cost of construction is lesser than your sale consideration. So whatever balance amount you have to pay the tax. He said, wait. How can you do that? I wouldn't consider the cost of the land. They said, sir, come on, don't be a fool. Because 1968 you purchased the land. The law is clear. 1 year before or 2 years after only. So you have done this all in 2015, 2016. If it is 1 year before, we'll allow it. Even if it's 2 years before, we can consider. You cannot tell me 1968 land, whatever cost of acquisition, you want to add it now. And you have to say that that also has to be considered for your reinvestment purpose. So this case went up to the Madras High Court. And the Madras High Court held in the favor of the assessee. Yes, the land purchased in 1968 also you can include that cost. So I don't agree with that decision. I think it's wrong. But the decision is there. It's in favor of the assessee. So everyone in Madras is taking advantage of it. So it's a very useful decision for us. So you can also take that judgment and use it to your advantage. So it's a very, very interesting judgment, a funny judgment, I should say, but beneficial to the assessee. So we can claim it and take the benefit. Now, next is a very, again, a good common question. Can I reinvest, but in the name of my spouse? I am the seller of the property, but I am reinvesting under 54F in the name of the spouse. Can it be claimed? Yes or no? No, yes. We are getting some varied answers here. Some people saying yes, some people saying no. It's a very common thing. No, people want to reinvest. I want to sell my property. I want to reinvest in the name of my daughter. I want to reinvest in the name of my son. So as sir said, jointly with wife. Yeah, you can jointly, you can do it. Now here, I got one interesting answer from someone here saying from spouse, it's okay. Now here, that is the right answer. I'll tell you why. Now there's an old case called CIT versus Natarajan. It's a Madras High Court case where they said it's just an open shut case. They said, of course, you can reinvest in the name of spouse. No questions asked, just allow it. But the case didn't go into a little bit more detail. I'll tell you why. Let's take an example. I have a large family. I have, let's assume 8 children. I have 4 wives, or I have 7 wives, whatever. So I say, okay, every time I sell a property, I'll reinvest in the name of a spouse or a child. So I'm selling property, reinvesting. Selling property, again, reinvesting in the name of a spouse. So legal wife, okay, sir, one wife you keep. So every time I'm selling, I'm reinvesting in the name of that one wife, not the other wife. I'm reinvesting in the name of the one wife. Now here, CIT Natarajan did not consider one important aspect. In whose name will the income from the house property be taxed? Should it be my name or should it be in the wife's name? And if it is the wife's name, when I'm once again selling and I'm reinvesting under 54F, there is a condition, no? Under 54F. Assessee should not own more than one house property as on the date of sale. So will that one house property that I've reinvested in my wife's name also be considered for that one house property, or that need not be considered? So these aspects are very important aspects because that will defeat either 54 or 54F. And this was not considered in CIT versus Natarajan. That is why in Delhi, there was a case called Kamal Bahal. This case came up, and there are a few more cases where they said, even in these scenarios, you can still do it. But some case came out and said in Punjab and Haryana, I forget the name of the case, but in Punjab, Haryana High Court, they said, if the wife is an independent person, she is an independent assessee, then in that case, you cannot claim it as reinvestment unless you are following clubbing of income. Unless when you reinvest under 54F, you are claiming that property also to be yours. So you cannot legally every time reinvest in somebody else's name and say, I have only one house property in my name, I only have one house property. because it's your funds that you're putting in their name. So essentially, it is your income. So you can reinvest in the name of the spouse, provided you take into consideration the clubbing, you take into consideration for 54F that you are owning the property. So that's a very, very important point when it comes to investing in the name of a spouse or any other person for that matter. And one more very practical, interesting case law. So once again, I'm going to invoke the convener's name. So Jitendra Ji is my very, very good friend. So he says, Abhishek, I'm starting a business. I'm going to take a loan from the bank. I said, oh, great, sir. Congratulations. All the best. He said, I need some help from you. I said, tell me, sir. He says, you give me your land as collateral for my loan. I said, okay, sir, you are very dynamic. You are a wonderful person. Amish ji has also referred you to me. Therefore, I am definitely going to give you. So here, I'm giving my land as collateral to the bank. So what does Jitendra ji do? He is doing great. Business is going well. COVID hits. Suddenly, he starts defaulting on the loan because he's unable to pay. And then the bank says, okay, I'm going to seize this land. And they sell the land to adjust it against the loans. Now here, I am the guarantor for Jitendra ji, or I have given my property on collateral. The bank is selling my property. I have not got any money from the bank because it's adjusted against Jitendra ji's loan. Do I have to pay capital gains tax? Here, I have not got any money. Jitendra ji has also not got any money. Only bank has got money. But they have also lost their money through the loan. So here, who is taxed this income? This capital gains, in whose hands it's going to be taxed? Now, there is one concept called diversion by overriding title. Diversion by overriding title. So there's in fact not many decisions on this. There are only two decisions. And the most popular one is this Trisema Abraham. It's the Kerala High Court decision, where they've held that diversion by overriding title will be there. So in this case, even though I am the one who has sold the property, technically it is my property that is sold, the benefits of that went to Jitendra ji. So therefore, he needs to offer it to tax under his head. I cannot be taxed. So I will show the sale and I will say diversion by overriding title. He should offer as income from other sources and offer it to tax. But that is not the view held practically in most cases. In over 90% of the cases, it has been held that Abhishek only has to offer it to tax. I'll say, sir, what is the money that I have got? You may not have got money, but even any benefit that you have got in kind is taxable. I said, what benefit I have got, sir? Did he give me a seat on his director's board? Nothing. Did he give me any other benefit? Did he give me a car? Nothing. Did he help me with anything? Nothing. So what benefit I have got? That satisfaction, no, that my friend has got a loan. That is my consideration. So therefore, that is your consideration. So you have to offer it to tax. That is the view held now largely. So diversion by overriding title will not apply in these cases. It's a very aggressive stance if you say that's diversion by overriding title. But in these cases, it will be taxed still in the owner's hands only. That is the view that has been taken. I'm just going to do one more case, then we can maybe take a few questions before wrapping up. This case is, once again, a practical thing, because both under section 54 and 54F, they repeatedly use the term residential house property. If you own more than one residential house property, if you reinvest in a residential house property, you have to sell a residential house property. You have to sell other than a residential house property. When they say residential house property, I can ask you a question. Most chartered accountants today in India, wherever it is, Bombay, Chennai, Delhi, wherever you are, even in the small towns, many CAs run their office out of their own house. Sometimes ground floor, sometimes single room, sometimes hall. Like this, many people run their office out of their house itself. Now, I decide to start a business, or I decide to start my practice. So I say, okay, my practice is going to happen in my house. So here I am, I'm starting my practice. Then suddenly after 1 month, so my in-laws come and say, Abhishek, what are you doing? Why are you practicing as a CA? We have a big business. So why don't you open a branch here and you do the business? I say, okay, fine. So I surrender my COP and then I convert it into a business. And it's happening in the same premises. After 1 month, we are going to have a child. So my wife says, no, we need more space. So you please close down this business over here. We cannot have it. Make it a room for the child. Say, okay, fine, I close. So for first month, it is a COP. It's a chartered accountant office. For the next few months, it is a business place. That after that, for the next 6 months, it becomes a house. Then after that, I say, listen, I want to start another business. So I'm going to make it an office again. So once again, I make it an office. So in a span of 12 months, that same premises has become residential, office, once again residential, once again office after. So repeatedly, it has gone through multiple changes. So the question that I'm going to ask you is under 54 and 54F, when they talk about a residential house property, do they mean use or do they mean nature? Because if you talk about use, this is an example where the use, how the property is used, has undergone so many changes in less than 1 year. How can I determine that to be a residential house? Or is it the nature? When I say nature, if it happens to be, it's a residential house property, which means there's a hall, bathroom, bedroom, kitchen, all of these are there. That's traditionally considered to be a residential house property. So it may be a flat, it may be, an individual house. So if you see the structure, if it is that of a residential property, then that is considered to be a residential house. If the structure is that of a commercial property, then that is no longer a residential house. So these are the two interesting views. Now here I'll give you another example. There happens to be a residential building. Let's assume it's a flat. There are around 6 flats in that building, and all 6 flats are owned by the same person, and they're running a school there. They're running a school. So a business is being run over there, a school is being run over there. In this case, can you tell me whether it's residential or commercial or a non-residential? Is it residential or non-residential? It's a flat, proper with kitchen, bedroom, etc. But all 6 flats owned by the same person, and it is run as a school. They're running a school there. Here one science lab is there. Here one commerce lab is there. Here classrooms are there. Then outside play area is there where the parking is, etc. So is it residential or is it non-residential? So I can see again, once again, people giving different answers over here. Many people saying it's non-residential. Some people are saying it's residential. So here is once again, as you can see, there's a, what do you say, a clash in the views. Now somebody has said, as per revenue records, you should see. That's a very, very interesting view because it's very hard to say who's correct, who's incorrect. But here, my personal view is that you must see the nature of the property because that is something you cannot change. Today it's an apartment. Tomorrow I cannot change it to become a commercial place, even though it's having kitchen, etc. If I break it down the walls and I remove everything, I can renovate it. That is different. But as it stands today, it is residential in nature. So if I buy it, I can use it as a house mostly, or I can use it for something else. But the use can keep on changing. The only thing of permanence is the nature. So in my view, if you want to determine if it is a residential or not, you have to see the nature. But the Hyderabad ITAT, in this case, have held the same thing, where they said you must see the nature of the property and not the use. But very recently, both the Delhi ITAT and even the Karnataka High Court has said that you have to see how the property is used. You should not see the nature. You should see how the property is being used. So if it's regularly being used for commercial premises, then it's commercial in nature. You cannot say it's a residential property. But this view I don't agree with, but that's a very interesting distinction. So ultimately, my point to you all is that if you are faced with the circumstance, you have to take a stand that it is residential in nature. And if the issue comes up, you have to say how it is not being used can constantly change. So you must see the nature. If the nature is that of residential, then it should be given as residential only, if it is beneficial to the assessee. I think I will wrap it up with this because I have a lot more case laws, but I don't think we'll have the time to cover everything. So I saw a few questions, so maybe I'll take up the questions. Jitendra ji, should I do that? Because I saw some questions in the chat box.
Yes, yes.
Okay. So, and if anybody has any other questions, you can please feel free to put it up at any time or unmute and ask. So Girish ji has asked, if the auction price is lower than the guideline value, would 56(2)(10) apply to the buyer, and the difference between guideline value and auction value? 100% will apply. 100% will apply. In fact, that is a prime reason why they have brought this provision. Because in bank auction, in the seizure auction, income tax auction, the property auctions, in there tends to be bidding groups, people who come into collusion, and they will bid in such a way they will adjust behind the scenes between each other, but the ultimate bid will be much lesser. So they have deliberately done that. That is one of the reasons why they brought this, but it's affecting everyone else also, unfortunately, these provisions. Krishna Chand sir has said, please share your PPT. I will 100% share. I will send it to the organizers. And of course, I have put my numbers also here. Any point of time you can ask me, I'll be happy to share. I'm also using this opportunity to market my YouTube channel. So I have a YouTube channel. Please follow me. I'll be I'm very happy because I regularly upload income tax videos. So I'll be sharing things over there also. Sir, in case of redevelopment of society, there's an agreement among members. Developer of a different consideration. I think this was the point which was discussed earlier. Whether members are mandated to follow 45A, 45.5A. I think you're asking whether the JDA provision, that is with the price at the completion certificate when it is issued, will it be taxable at that point? Is that your question, sir? Okay.
You can unmute yourself and ask.
Yeah, maybe more specific, you may be able to give, Arunji.
Sir, whether he is mandated to follow 45.5A, he is holding the asset till the completion certificate or occupation certificate is received. Whether he is mandated or he can follow the normal provision, because the 45.5A starts with notwithstanding anything contained in 45.1.
No, what he has given his property in turn and the construction is happening. Is it a specified agreement? So when it has to be registered, it has to be a specified agreement. It should be in the nature.
He will comply with.
Sorry, sir?
At all conditions, he will comply with.
Then 45.5A has to be followed, sir.
So he cannot follow that the possession is given. So the year of transfer is the year of possession given, and then take 3 years benefit of construction and of 54.
No, so here this is the interesting thing, because once again you have to see on a case-to-case basis. When I say case-to-case basis here, I mean you have to see the nature of the agreement. What is the benefits you are getting? I have a land. I've given the land. I don't have the resources to construct on it. So I come into an understanding with the builder who has the resources, but he doesn't have the money to buy the land. I say, you construct 10 flats, you build. At the end, when you build 10 flats, you give me 3 flats, you sell 7 flats, or you sell my 3 flats also. But ultimately, I get the benefit of a constructed flat. I get common facilities. The value of value of the property goes up. So all these benefits I am getting from the property that has been constructed.
But in
So
this
these three,
society, whether I can follow 45.5A, because
if it is the example that I just told you, similar to that, then you have to follow 45.5A only. But suppose I am selling the property before. Let us assume midway through the construction, somebody comes and tells me, oh, I heard it's a great flat. I heard you have the rights. Can you sell? I will sell the property. I'll say, yeah, okay, I will sell it. Then in that case, the date of the sale, when I'm selling the property to this person, even though construction is not complete, my sale consideration will be taxable in that year and it will be capital gains of that year.
A normal provision applies.
Yeah, normal provisions will apply in those cases. In fact, 45.5A specifically carves out an exception for that sort of scenario. So if they are selling it before the completion, then that will apply, sir.
No, completion, after completion, it is beneficial to us because that 54 easily applies, that period of construction and all that.
No, I agree. Most people will prefer 45.5A because it gets deferred, their taxation. So that is what most people want to follow.
Yeah.
Yes, sir.
Thank you, sir.
Thank you, sir. Sir, in case of redevelopment, whether to show sale of old property in exchange for new in ITR. Sale of old property, no, you will just be showing a different property. Maybe the address may be different or something, but you will be showing a different property there. So in case of redevelopment, that's how you will be disclosing it in the return. So TDS on agreement of
a new flat in exchange of our old flat we give for redevelopment. So whether to show in ITR or not to show at all.
Can you give me maybe an example?
Society goes into redevelopment, and we get in case of a 2 BHK, we get a 3 BHK flat in exchange.
Okay.
Whether we should show that or we should not show that at all.
You have to show it. The reason being, naturally, maybe the address may change or unit may change, etc. That is one. So you have to disclose the correct address. And secondly, there may be some benefit that you're coming now since 56 to 10, etc. has come. If there is a benefit in value that you are getting out of it,
you may have to offer to tax that. Whether you should show it, obviously, when I'm on screen, I have to tell you, yes, you should show it. Whether you will show it at the end, you will see what is beneficial for the client and you will do it.
Because
So-
generally, if we say we give 1,000 carpet, we get
Yeah.
around 1,300 carpet back. That's the usual one of calculation out here.
No, you're right. In fact, my relatives I had in Chembur also a similar thing happened.
Yeah.
So old flat, they got a new one and it was bigger in space. It was, much better looking also to say.
With
So
amenities and
there's a benefit ultimately that you get. The value of the property also goes up. So to me, it appears to be unfair if you don't disclose that. So it has to come out.
But then 3 years timeline will start from
Oh,
sale.
no. So from that point of view, that depends on the agreement once again. What are the terms of the agreement, how the JDA is structured, etc. So if there are the terms that you are ceding, maybe you may lose UDS in the process, right? So I might be getting more square feet, but I'm losing UDS. The moment I'm losing UDS, that is a relinquishment or a sale, etc. It's a transfer. So in those cases, 45(5)(a) may arise. So that is what you have to consider. Sir, in case of acquisition by government, whether there'll be any change if it is compulsory or voluntary, it does not matter whether it is compulsory or voluntary. In case of acquisition by the government, the taxation is the same. The only difference when it comes to compulsory acquisition or voluntary is one important, or rather I can say two. I'll tell you why. The second one is interesting. The first one, I may have a legal issue. Normally the government will acquire only at the guideline value and the fair market value may be substantially more. So I'll file a case at the High Court and I will go for, what we call increased compensation. The increased compensation may come 5 years later, 5 years, 6 years, sometimes 10 years, 12 years later. So when I get that increased compensation, I can still offer it to tax as capital gains only. I need not offer it under other sources. I need not say it is exempt. I must offer it as capital gains. Cost of acquisition will be zero, but at least whatever increased compensation I'm getting will be taxed at a 20% rate. So that's an important thing. If there's any carry forward of loss, of course, I can adjust it against that. Now, the second scenario, why I told you this compulsory voluntary, is very recently in one of my clients' cases. What happened was land was acquired under the Central Government Act. And central government had carved out under income tax, they made a special exemption for this. So they said in these cases, the lands which are acquired through this specific act, through this specific acquisition, will not be subject to capital gains tax and it will be exempt. It was the first time I had come across that. I had not seen that before. It happened to be a very large land which they had got in Chennai actually. And the central government had got it, they were able to exempt it from tax. So in those cases, you don't have to pay the tax, but it will clearly state that in fact the government notice which they are sending about the acquisition, they will specifically state that they have got a circular where it is exempt from tax. So in that case, you don't have to pay the tax also on that. So in case of redevelopment of property, builder has offered a lump sum consideration for rent or compensation against rent, and at the same time is deduct TDS under 194 IA. Now is this income of the assessee or capital receipt in the hand of the assessee? He has offered a lump sum consideration for the rent. So in my view, when you are getting such a compensation, which is basically till the completion of the construction, he is giving you a lump sum so that you can stay on rent elsewhere. Is my understanding correct?
Yes, sir.
So here, once again, for seeding your UDS, ultimately that is a transaction, right? He is not some person who is a Harish Chandra or some other Teresa who is coming and saying, come, you give me 1,000 square feet, I'll give you 1,300. He is getting some benefit out of it. You are losing something, right? So you will be likely losing UDS. So since you are losing UDS, that is a sale. And in connection with the sale, there are certain transactions which happen. In connection with that, this is part of the consideration that you are getting. You cannot say it's a capital receipt not chargeable to tax. You cannot say it's not chargeable to tax. It is what is the benefit you are getting for seeding your UDS. Now, ultimately, you may say, sir, it's essentially my cost. It's not a benefit for me. I'm getting that money and subsequently I am paying some money also. So in this case, what is the nature of it? So here, if you are not selling that property ultimately, so he is doing a redevelopment. At the time of redevelopment, you take it and you're not selling it. If you sell it, you have to add this as your consideration. If I'm not selling it, I am retaining this property, then I have to offer it under income from other sources and I can reduce my cost in connection with earning that income. So whatever rent I am paying, I can deduct it from that. I hope this is clear. So whatever I'm getting lump sum, I can reduce my cost. I'm paying a rent from against it. So essentially it will either be zero, or I may get some profit, or it may be a loss also. So you can definitely do that if you're retaining that property. Thank you, ma'am.
In some of the areas,
Mhm.
when the person is selling the plot,
Mhm.
he is not investing in the actual house. He just buy another plot and construction a small hut kind of a room kind of. So
Yeah.
it is advisable to clients, or
Yeah, it's a good, once again, very good practical question. Question this is. So the the act, what it says is it requires your assessee to construct a property within 1 year, by in case you're purchasing 1 year before, 2 years after. Construction means 3 years after. Now,
yes.
what do you have to construct? If I have 7 acres of land, I'm building one small tent over there. I'm saying, sir, I've got a house. So this is what many people did also. So what they have said, what is a house first? What is a residential house property? That is determined. So they say certain conditions are there. There must be a kitchen, there must be a bedroom, there must be electrical connection, there must be a water connection, certain other, how the tiling is done, how the roofing is done. It cannot be a thatched roof. It cannot be a tiled house. It must be a proper house. Must be concrete in nature, the structure. There must be permanence to it. So all of these conditions are there when it comes to building a house. So these are the minimum conditions I have to do. But these conditions I can satisfy even with a 200 square feet or 300 square feet property. I can build a kitchen, I can build a bedroom, I can get a bathroom, etc. And I have 7 acres of space. Does that satisfy the law? If I see from a legal point of view, reading the law, it definitely satisfies it. But at the same time, as I told you, the facts and circumstances of each case will be examined. So if your assessing officer, faceless, they don't care. You're saying I reinvested, you take a photo of the room, they are very happy. Ah, okay, you're satisfied, great. But if some person goes a little bit more detail, he says 7 acres, what you are doing with this small house? It's not possible. It may be a farmhouse. I have a client who has a huge, farm in Karnataka, where they have a small house in the middle of it, and the rest of the area is all their farm. But they are actually doing farming activities. So in this case, it is acceptable. But in a case of a normal assessee who wants to keep it as a land, but just to satisfy this requirement, he builds a very small unit. Then in that case, does it satisfy? Technically, it does. But from a practical point of view, you may face a challenge in times of assessment. So if you warn your client in advance, maybe Jitanderji, that there is a risk associated with it. We can do it, but we'll have to fight the case. If you're okay with that, you can, proceed. I think if you go with that sort of approach, it may be better to the client. But to answer your question, yeah, it is correct only, but at the same time, we have to be careful.
Mr. Kishore Narayan. Mr. Kishore Narayan, TDS on agreement of construction.
I didn't
50
understand
lakhs.
that question actually, sir.
TDS on the agreement of the construction cap 50 lakhs. Yes. TDS. Can you unmute yourself, Mr. Kishore?
Is it about 194M?
No, sir. See,
5%.
normally when you purchase, with the builder, the new property,
Yes,
you
sir.
will have 2 agreements they put. One is on the UDS registration. The
Yes.
other one is on the agreement for construction.
Yes, sir.
Here, the practice what is prevailing is that they are not considering the 50 lakhs
Mhm.
on the agreement of construction.
Mhm.
That is what happening in Chennai. But I just want to know the exact the act ruling on that.
Because 194M is relatively new, there are not enough decisions on that, really speaking. But 194 IA is clear that when you are purchasing a property in excess of 50 lakhs, 1% TDS has to be deducted on it. Whether I am entering into sale agreement for UDS, whether I'm into construction agreement separately, it is normally bunched up and taken as a whole. and the entire consideration can be taken. And every time as a buyer I am making any payment towards this, 1% I will deduct the TDS on that.
Sir,
So-
but I got a legal opinion taken from one of the leading advocates here in Chennai.
Mhm, mhm.
But they have given that that need not be considered. If you want, I can just share that also to you later,
Yeah,
maybe. I
Maybe
have
you can
your
just share that with me, Kishore.
WhatsApp, I can share you.
Yes, sir. You can share it. But my view is, as chartered accountants, we believe in substance over form. So if, ultimately the purpose of having that 1% is for tracking. That is what it is. It is not for, they are not getting any big consideration by deducting 1% out of 50 lakhs. But it's ultimately to track the transaction. So if we take substance over form, it is has to be done. The only reason why it will normally be done is because the buyer wants to be careful. He does not want to get into a problem, because ultimately this 1% is a duty on the buyer. If the buyer defaults, the buyer has to face the penalty. He has to face the music. Seller will be happy if you don't deduct, but the buyer, it is cast as a responsibility. So when most of us are advising the buyer, then we can advise them to deduct the 1%.
Because
So-
what their contention is that since GST is already applied on that agreement for construction, which you pay for,
Yes,
on the
yes.
UDS registration, no GST.
Yes, yes, yes.
Or on the agreement of construction, since already the tax is applied,
Yes.
it is considered to be a sale transaction, then why TDS to be done? That is
Yes.
a ruling they have given. Actually, I don't know. But this is what their contention, and most of the builders, they are doing that here.
Yes. No, I understand what you're trying to say, and I also agree with it. But my point is, as a buyer, you'd rather avoid any sort of risk. So you'll have to fight it. In your case, you have to get an opinion. You have to put it before the TDS commissioner. You have to explain that is why TDS is not deducted. He has to accept it. So all of these, what do you say? For one small transaction, you have to do such a complicated thing. Ultimately, for the buyer, it doesn't matter. It's just an outflow for him. Either he is paying 99% or he is paying 100%. So I don't think from a buyer point of view, it would be advisable. Maybe if you're representing the developer or the seller, you can consider it.
Okay, sir. Thank you.
Thank you, sir.
Yes.
I think you cover all the questions.
Yes, sir. So thank you
Last
very
one
much
has
for the
been
opportunity.
Just last one, I think we can take.
Yeah,
Yes, sir. Yes, sir.
Suhas sir has posted here.
Sir, if I borrow and invest, can I capitalize the interest on borrowings to the cost of new asset? You can do that, provided you are not claiming it under Section 24 in income from house property. I cannot take as the interest paid on loan over there also, or pre-EMI interest, everything over there, 5 years I will amortize it, and then I will take it here also. So you cannot do both. Now, if it's a land, for example, I am borrowing to buy a land, then Section 24 does not arise. It does not come under house property. So any interest I'm paying, I can 100% add it to the cost of acquisition. So you can add it. There's no problem there.
If interest exceeds rupees 2 lakhs, we can capitalize it.
You can, there's nothing wrong in it. The auditor may have to report it. So, so I think we're completed. So thank you very much for very patient listening. And I thank the convener organizers for giving me this opportunity. So thank you very much. Over to the organizers.
thank you, Dr. C. Abhishek ji, for making houseful Zoom meeting on the Friday evening and making such effort. You are covering all the sections, all the season, range from the cryptocurrency, land, agriculture, plots, everything you cover in the capital gain. And as you said, that the all season topic is the capital gain. So you cover all the things. We, on behalf of Andheri Oshiwara Study Circle, I give you heartily vote of thanks. Thank you, sir. We will be in touch, and in future webinar also we will calling you.
Definitely, sir. Thank you very
Thank
much.
you. Thank you very much.
Thank you. Thank you. Thank you all.